Hi, I'm Sean Millington. In this, our sixth video in the series, we will discuss mutual funds. Most investment professionals agree that it's smarter to own a variety of stocks and bonds than to gamble on the success of a few. This is called diversification. One solution for building a diversified portfolio is through the use of mutual funds. With mutual funds, you pool your money with other investors and pay a professional money manager to make the investment decisions. Most mutual funds are open-ended, which means there's usually no limit to the number of shares issued. As you invest your capital is added to the pool of money being managed. Investors both buy and redeem these mutual funds directly with the mutual fund, often through their financial advisor. The price of the shares is set at the close of each day based on the value of the individual securities within the fund. The second type of fund, closed-end funds, more closely resemble stocks, as there are a fixed number of shares available and they are traded on a stock exchange. The market price of a closed-end fund fluctuates depending on investor demand and therefore rarely matches the actual net asset value of the securities held within the fund. With more than 13,000 different mutual funds in Canada, including more than 60 offered by TD Canada Trust, it is possible to find a mutual fund to match any specific investment goal. Some of the more common are money market funds, bond or fixed income funds, stock or equity funds, as well as balance funds, which combine bonds and stocks. Within these broad categories, there are sector or specialty funds that own shares in a particular industry. There are precious metal funds, which hold shares in mining companies or physical commodities such as gold or silver, energy funds, health science funds, real estate funds, and internet funds, to name but a few. There are also a growing number of global funds, which are a popular way to invest in specific countries or areas. However, one should be careful as global funds can expose investors to currency risk. Although mutual funds offer diversification, some are riskier than others. For example, a fund that invests in small new companies takes a chance that many of their investments may do poorly. Mutual fund companies have also created funds to attract investors with strong political or social commitments. A specific fund might avoid tobacco companies or companies with poor environmental records. Mutual funds are also highly regulated. One of the cardinal rules is that all potential investors get a prospectus before they buy into a fund. The prospectus must be explicit about objectives, management fees, performance, and all of the details of the fund's operations. Mutual funds are also categorized on the basis of the type of sales charge or load that is levied. These fees may be charged as a front-end load when the investor initially makes a purchase, or as a back-end load when the investor faces the possibility of a fee to sell or redeem his or her fund. Many redemption charges decline the longer the investor keeps the investment in the fund. Mutual funds offer many advantages and a few disadvantages for those who buy them and are better suited for some investors. Some of their chief advantages are professional management, diversification, liquidity, variety of funds, and a variety of purchase plans. For most people, the main disadvantages to funds are the costs associated with having your capital managed, in addition to the challenges involved to uncover funds that have strong performance and appeal to your own investment style. With the exception of money market funds, mutual funds are generally unsuitable for short-term investment. Although funds may hold hundreds of different investments, most only report their 10 largest holdings, which to many investors is also a disadvantage. Before we finish our discussion on mutual funds, let's take a look at the tax treatment applied to funds. During the year, a mutual fund will incur capital gains and losses when it sells securities held in the fund. These gains are distributed to the investors much the same as interest and dividends are distributed. Each year, shareholders receive a T5 from the fund reporting all income paid out over the year, including dividends that investors reinvested to acquire more shares. This T5 covers interest, dividends, and capital gains, each of which is taxed at the fund holder's personal rate, subject to the dividend tax credit and capital gains. Furthermore, when an investor redeems any shares and withdraws the proceeds, any gains or losses realized at that time are also subject to the appropriate tax laws. A potential problem arises when an investor chooses to automatically reinvest income into additional shares. The combination of cash purchases plus reinvestment of income can make it difficult to calculate the actual cost base, and if careful records have not been kept, an investor could be taxed twice on the same income. Furthermore, if this distribution of capital gains is done only at year-end, it can pose a problem for investors who purchase a fund close to the year-end. For example, if a fund has had a great year and an investor purchases shares in the fund at $20 on December 15th, just prior to the fund distributing $5 per share, the $5 is taxable in the hands of the new investor, even though it was earned over a much longer period. An investor should look for any potential distributions or hidden taxable gains before buying into a fund. In summary, mutual funds are a very useful tool, but as a client's portfolio grows, it might be argued that there are alternative ways to invest that are more cost-effective. Would someone with $2 million invest in the same way as someone with $10,000? That wraps up this segment. Please come back and watch our other segments. I'm Sean Millington, an investment advisor with the Rickerby Wealth Group at TD Waterhouse Private Investment Advice.